Good morning and welcome to Charting the Markets on Friday, the 3rd of March. Now, overnight, US equity markets bounced back from an intraday one-month low, and that was on the back of the US Fed President Raphael Bostic saying that he'd be quite happy with a 25 basis point rate hike at the next Fed meeting. And also investors basically looking towards China and it providing a generous stimulus package at its next parliamentary meeting next week in order to support the Chinese economy. So overnight, basically, Asian markets rallied on the back of stronger US markets, and that also filtered through to European markets this morning. And as we can see here on the daily financial bet of the FTSE 100, we have now seen 2 days of consecutive higher prices, and today we continue to head towards the psychological 8,000 mark. Now, for the bulls to really be back in control, what we actually would need to see is a rise and daily close above the all-time high, which on this daily financial bet is at 8,044. We had some negative divergence previously with regards to the relative strength index, which was making a lower high when the index was making a new all-time record high. And that has led to the recent decline we saw to Tuesday's low at 7,854, marginally made above the 10th of February high at 7,850. So this is really the key support area going forward with regards to the FTSE 100. But as I said just now, short term, we are looking positive with regards to the FTSE 100, and we may well retest the psychological 8,000 mark. And we'll have to see what really comes out of Europe today, because we've got a plethora of European services and PMI data out, and we've also got some European central bankers speaking today. So we'll see whether this current upside momentum can keep going today. Now, moving on to the German market, what we can see here is that the DAX 40 yesterday dipped down to a one-month low, taking us back to levels last seen at the beginning of February on this daily financial bet at 15,145, but then formed this bullish hammer formation, which is today taking us back to the February to March downtrend line, which currently can be seen around 15,472 on this daily financial bet. So this is important resistance short term. Above this level, we have the 23rd of February high at 15,556, and obviously all the previous highs going back to 15,656. And as long as those cap, there may still be a possibility of us sliding, because yes, we've been trading sideways for the last month or so, but if you look at the daily chart, you can see that we have a series of lower highs and also lower lows so far. So a very, very slowly downward slanting downtrend channel. But as I say today, the momentum is clearly to the upside. Now, what is likely to happen will really depend on what we will see with regards to a close today on Friday, because that's a weekly close. Because as you can see here, we actually bounced off the October to March uptrend line, and we slipped through it yesterday, but did close above it. So for the bulls to be back and remaining in control, we really want to close above this uptrend line and also above this week's low. So as long as we stay above 15,145, the short-term upside momentum may take us higher still if we were to break through this downtrend line in the days ahead. With regards to US markets, now they are looking forward to the US ISM non-manufacturing PMI data for February, which is out at 3 p.m. today, and we expect this to fall to 54.2. And what we can see here is that we have bounced off the red line here yesterday, which was the 200-day simply moving average at 3,940. And also in doing so formed this bullish engulfing pattern on the daily candlestick chart. And what that does is basically engulf the previous day's bearish candles body, which is the difference between the open and the close. And you can see here yesterday we opened below the prior day's close, but then closed above the prior day's open, which is bullish. And it might take us today back up towards the breached October to March uptrend line, which could now, because of inverse polarity, act as resistance. And this comes in around 4,002 today on this daily financial bet. So we'll see whether we can stop going up around that level or not. If not, we could be heading back up again towards the 23rd and 27th of February highs, which were made between 4,018 and 4,026 on the S&P 500 daily financial bet here. So once again, the 200-day simple moving average, just like last week, has actually acted as support. And it is really, really important that it continues to do so for the bulls, because we have given back quite a lot of the gains we saw between January and February so far on the S&P 500. We'll have to see now whether we can hold above the 200-day simple moving average. Because if we can't, and if we fail next week and close below this week's low at 3,920, then we would have the mid-January low at 3,886 as our next downside target. But we would then also open the door basically for the December low at 3,764 to be revisited. Now, the US dollar has risen on stronger economic data coming out of Europe and also the US over the last few days, especially the US markets. We saw a stronger PCE price data come out last week, and that has led to a surge in the US dollar basket. But in the course of this week, we did have a slide down on Wednesday on European data, which also with French inflation, for example, coming in higher than expected. Basically, in Eurozone, PMI data and inflation data being quite strong, telling us that inflation is not really coming off as quickly as we hoped it would. And that has basically led to the US dollar trading sideways this week in a lot of volatility. So this change between US and European data coming in stronger than expected with regards to the inflation front. So where are we at the moment? Well, basically, technically, we are still above this resistance area I've been mentioning over the last few weeks, between 103.08 and 103.63 on the US dollar basket, which was a previous support area. And the close we had above it on a weekly closing basis last week basically told us that we have formed a bottoming formation now with regards to the US dollar, and that the US dollar is likely to rise further in the days and weeks ahead. And we could then continue basically our upside momentum as long as we stay above this well-known 308 low from mid-December, and retest the January high at 105.37 and also reach the 200-day simple moving average here at 106.23. So I still expect further upside to be seen with regards to the dollar. And right now we're just trading sideways above this key support area here. And basically we can also draw in a trend line which supports this current upside momentum, which I believe will continue in the days and weeks ahead. Now, because of the euro making up 57.6% of the US dollar basket, the inverse is seen here on the euro dollar daily financial bet. And as you can see, this one has formed a bottom on Monday at 105.33, has taken us back up again towards the 107 area, below which we are currently sort of sideways trading. But again, here we don't see a major bullish reversal in euro dollar unless we were to take out the 108.04 mid-February high, which is part of this resistance area with the mid-December high at 107.36. So 107.36 to 108.04 is still really important resistance with regards to euro dollar. And basically, as long as we stay below them, the odds actually point towards the 104.84 to 104.44 support area to be revisited in the next few weeks or so. So further likely downside to be seen once this minor correction against the February to March downtrend has run its course. Now, moving on to euro sterling, what is interesting here is that we've seen a lot of volatility also around the Windsor Agreement, that is to say the United Kingdom's agreement with the European Union with regards to the post-Brexit deal, and also the Northern Ireland Protocol. And basically we had some strength with regards to the euro versus the pound sterling as the pound sterling came off on this euro sterling bet chart. But right now this seems to be running out of steam as well. And basically, you can see here we are just trading in a sideways trading range, and every time we try to rise and close above previous levels, we fail. I mean, as you can see here, we failed once more at the February to March downtrend line, and are likely now heading back down again towards this December to March uptrend line. Commodity markets have also been affected by the recently stronger dollar, and then also midweek by the slightly weaker dollar. And now that the dollar is rising again, that hasn't had such a big impact on the commodities such as gold, for example. As you can see here, the gold price over this week has actually risen and is on track to now have its 5th consecutive daily higher high. And we are approaching the minor resistance area here, dating back to the 20th of February, which is around $1,847 and $1,850 per troy ounce. And we'll have to see whether we will be capped by it and the 3rd of February low here at $1,862. That is important because we had a very sharp decline here, take us lower with 2 big candles on the daily financial bed. And basically the low of that decline is quite important resistance going forward. But short term, we are pushing towards that resistance on the slightly less strong US dollar that we're seeing at the moment. And it looks as if we have formed a minor bottom on $1,805 per troy ounce short term. But for the bulls to really be back in control from a medium-term perspective, and meaning by that this November to February uptrend may continue, what we would really ideally want to see as a rise above the 9th of February high at $1,890, and we are quite a long way from there at the moment. Moving on to Brent crude oil, what is interesting here is that something similar has happened in that the price of crude oil has once again bounced off support. You can see here this December to March uptrend line. It came in at $80.30 and has led to the current increase in the price of Brent crude oil to around the $84 mark. But what we can also see is that the volatility has come out of this trade at the moment. As you can see here, we have formed a doji yesterday, and today there's very little volatility as well, probably because markets are waiting for the US ISM non-manufacturing PMI data out for February later today at 3 p.m. and that might give us an idea of what the Fed's likely to do going forward, and it might also have an impact on the oil price. Now, with regards to the oil price here and Brent crude oil, we can see that we are trading back in the middle of this November to March sideways trading range. But basically, as long as you stay below the 89.35 high from December, from early December, we remain in a longer term downward trend, which has been interspersed by this sideways trading range at the moment. So probably little upside momentum to be in store in the next few days with regards to Brent crude oil. Now, let's finish off by having a quick look at copper, because the price of copper has been quite volatile of late. It fell quite sharply last week and held marginally above this key support area I've been mentioning for the last week or so, between $8,629 per ton and $8,593 per ton, made up of the November and mid-December highs. And basically what we've seen since is another up move, taking us back up towards the January to March downtrend line, which again has capped and led us to fall. You can see this negative piercing pattern here yesterday on the candlestick chart. So I wouldn't be surprised if the price of copper were to slip back down again towards this uptrend line, so taking us back down towards the 8,800 mark or so in the next few days as well. So from a technical perspective, from a medium-term outlook point of view, what we really need to see in order for further upside to be seen is to have a daily close above the $9,212 mark in the next 2 days, next few days and weeks. So if we rise above 9,212, then the 9,951 high from January might be back on the cards. If, however, we were to fall through this 8,629 to 8,593 support area, we would then most likely slide all the way back down again towards the 200-day simply moving average of 8,297. So traders at the moment should probably just wait to see in which direction this breakout were to go with regards to longer term trading. But short term, as long as we stay below the current March high at 9,137, I expect slightly more downside to be seen in the next few days. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.